Hello, Tim Kerin here from Mortgage Choice in Kingsley. Today I just want to have a brief chat about interest rates, but don't switch off. What I want to talk about is what the Reserve Bank does and how it relates to the interest rate on your home loan and whether your home loan interest rate is about to go up or might go up if and when the Reserve Bank chooses to put rates up. So very brief background. In August 2016, the Reserve Bank dropped rates to the lowest they had ever been in the history of Australia, which is 1.5%, which obviously isn't the rate you've got on your home loan. That's the rate that the Reserve Bank, the Central Bank of Australia, is charging for people that want to borrow money off the Reserve Bank. So that's what they dropped their rates to. They don't meet in January, but they have met 21 times, so they meet in the first Tuesday of every month. So they've met 21 times since then and not moved the rate, left it at 1.5%. That's led to a lot of talk over a long period of time about what they're going to do next. And as of, it's July 2018 at the moment. And as of now, the conversation seems to be around maybe one day they will need to put rates up. Next time the rates move, they probably will go up. That tends to be what I hear. And the question that follows that is, when they go up, how much will they go up by, and how will that affect me? The answer to that, and the reason I'm making this video, is that the answer to that is different nowadays, in my opinion, to how it's traditionally been. Traditionally, 10 years ago, for example, and maybe as little as 5 years ago to some extent, when the Reserve Bank moved rates, they would do it by 0.25%. That still is generally true, although it didn't happen during the GFC. During the GFC, I still remember, I think everyone in the industry remembers when the Reserve Bank suddenly slashed rates by 0.75% in one hit and then another 1% the following month. In the 14 years I've been a mortgage broker, that's the only time Reserve Bank has moved rates by more than 0.25% at a time, or by anything other than 0.25%. So typically in a normal economic situation, the Reserve Bank moves rates by 0.25% at a time. But there's no guarantee of that. It's just a nice simple round figure, I suppose. When they do that, traditionally, the response from lenders would be that one of the big four would go first, and it was almost as if they're taking turns to do it, to increase or decrease their own rates by 0.25%. But the thing to be clear on is the difference between what the Reserve Bank charges and what a lender charges. The lender, if they did get money off the Reserve Bank, they would add on their margin before they sell it to you. So if the Reserve Bank rate was 4%, the lender might be charging you 5% and making 1% profit on that. 1% revenue, I should say, that they then have to pay their expenses with. Commentary about banks' profits should be left for another video. What that means is when the Reserve Bank moves rates, typically that's the what I have seen as social permission for banks to move rates as well. Moving rates down is something they tend to take a little while with. Moving rates up is something that tends to happen relatively quickly after the RBA announcement. And it seems that the big four banks take it in turns to be the one that take the media hit of going first. Traditionally, most lenders' standard variable rates would be about the same as each other. And when they moved, they would all still be about the same as each other. And I remember those days. Those were the days when I could remember what every bank's interest rates were. Since then, the world has changed. The GFC happened, and a lot more artificial intelligence has come into how banking works. A lot more data analysis has come into how banking works. And a lot more government regulation has come into how banking works. But the other critical thing, maybe triggered by the GFC, or certainly that started happening a lot more prior to and shortly after the GFC, the global financial crisis, for those of you who weren't around to remember 2007, 2008, I remember it very clearly. What's happened since then is that the places lenders get their money from has changed. So if you think about a bank trying to get money and then lend it to you, the incentive for them is to get the money as cheaply as they can, pay as small an interest rate as they can for it, and then lend it to you for as much as they can. That's how they make as much profit. And somewhere in there is they also need to attract your business in the first place by competing for business. And I'll get to that in a sec. So because that's become the dominant factor now from what I can see. So typically they might get their money from the Reserve Bank or from people's savings accounts or from securitized funds, which I won't go into. What seems to be happening at the moment, given what interest rates are like in Australia and given what they are like in the rest of the world, there are other countries where it's possible to get the money a lot more cheaply than you can get it for in Australia at the moment. If you look at Reserve Bank rates in other countries, it's pretty clear what's going on. Germany even went negative for a while there. So if the bank can get the money from somebody else in some other country at 0.25% or 0.5%, they're going to do that instead of paying the Reserve Bank 1.5%. So the reality now, at the moment, and this won't necessarily always be true, but the reality right now, and has been the case for some years now, is that the lenders are getting their money from someone other than the Reserve Bank, generally speaking. And some lenders, global banks, have huge amounts of savings at the moment that they're relying on. So they might be paying someone 0.75% or 0.5% interest on their savings in another country, and then lending it to you in Australia for 3 point something, 4 point something, 5 point something percent, and making a very big margin on it. So in the context of that, if the Reserve Bank moves their rates, that's really can be quite irrelevant to how much it's costing the bank to get the money and lend it to you. So just because the Reserve Bank moves rates these days doesn't necessarily mean the lenders are going to follow. What I would expect, and I could be wrong about this, is that when rates do move, some lenders might take that as the opportunity they need to move their own rates. But we saw a lender last week move their own rates up by 0.1%. We're seeing fixed rates move around a little bit, and fixed money does come from a different place to variable money. Typically there's big tranches of hundreds of millions of dollars that are borrowed at a fixed rate and loaned to the customer with a margin added on top. But I suppose, long story short, the way it seems to me to work now is that when the Reserve Bank moves rates, it might have trickle effects in the economy, and it might still have direct linkages to a lot of things. But it doesn't necessarily have an impact on a bank's margin. The thing I've seen influence rates far more than anything else since August 2016, when the Reserve Bank last changed rates, but also prior to that, is actually lenders competing with each other for business, and also lenders struggling to meet their regulatory requirements around how much investment lending they can do and how much interest-only lending they can do. All of those factors and the actual cost of funds are actually probably far more relevant at the moment to how much they need to charge you. So when a lender wants to compete for more business, they'll drop their rate. And they might drop their rate on a particular product, but not on all the others. So you might be an existing customer of a lender and be getting charged 4%, but they might offer a new customer to attract their business 3.7, for example. And then if you ask for them to look after you at the same rate that they're giving a new customer, usually most lenders say no, and they might lower your rate to enough to retain your business, and risk losing you. And at that point, I step in as your mortgage broker and say, well, here's a better option I can find for you elsewhere, with a lender that at the moment might have more of an appetite for whatever type of lending it is. It might be interest-only investment lending, or it might be principal and interest owner-occupied lending. Or it might be lending that's done at 95% of the purchase price, or it might be lending that's done at less than 70% of the purchase price. Those sorts of things determine what sort of business lenders are after these days, and how hard they're willing to compete for it. So I would think that when the Reserve Bank moves rates, it's probably not going to make too much difference to what rates lenders need to charge on residentially secured home loans. The reality is lenders are going to change their rates whenever they need to for a whole host of other reasons at the moment. So I hope that helps you think things through. If you're worried about what might happen when the Reserve Bank puts rates up, put it into context. Just have a look at, if rates do go up by 0.25%, multiply 0.25% by your loan amount. That'll tell you how much more interest per year you're going to get charged. If you want to know how your principal and interest repayment is going to change, it should go up by that interest amount. That's how the maths works. But if you want help figuring it out, I'm happy to do that with you too. But it may not have any impact on you at all. The Reserve Bank might put rates up, and that lender that you're with might decide they actually want to compete for more business at the moment, and they might drop rates 2 weeks beforehand or 4 months afterwards. So I guess in summary, the Reserve Bank rate seems to me to be becoming less and less relevant to what a customer will pay for a home loan at the moment. So I hope that helps you think things through. But if you want to go through things in a bit more detail and look at your personal situation and what might happen if and when rates change, you know where I am. Just give me a call, send me an email, and I hope you figure it out.